David Lafferty joining me. He's the chief market strategist over at Natixis Investment Managers, and we're going to take a look at his second half outlook. And David, it's been quite an incredible year for 2019. Do you anticipate that the second half is going to be just as interesting?
No, that would be a long stretch, I think. I certainly think it'll be interesting, but not in a positive way. You know, we're up 18, almost 20% year to date. In the S&P 500, my guess is the market probably climbs higher on, really easy Fed policy and earnings that will sort of come in dribs and drabs. I think they'll be positive. I don't think they'll be great. I think the market grinds up a little bit, but I think the easiest gains off that December, that 24th Christmas Eve bottom, the market just doesn't have the power to continue to rally at that rate. So I think the second half will be interesting, but certainly not as optimistic as kind of the first half indicated.
Yeah, well, I mean, even if we do get that anticipated rate cut, just the week and a half that we're in earnings right now, I don't think the quality of the earnings beats have been that significant. You might get it on the earnings side, but certainly not on the revenue side. And the beats that you are getting are still declines year over year. I don't think, 1 to 2% growth is that significant, coupled with a 25 basis point Fed cut to continue to get these moves that we've been seeing.
No, I don't think so. I think you bring up a good point. I mean, we're basically looking flattish, slightly negative, maybe 2% for this quarter, about the same as the bottom-up consensus estimate for the third quarter. Fourth quarter is supposed to be better, supposed to drag S&P earnings up to about 3 to 4% for the year. That's pretty lackluster, generally speaking. Again, it's positive, but it's certainly nothing. I'm not expecting the Fed to do enough or there won't be enough efficacy in the Fed's move to really drive the global economy to a much stronger place. So I think we can grind higher, but my optimism is pretty muted at this point.
All right, now you only see a 40% chance of a recession coming into the picture here, and it always kind of goes back to the yield curve, the inversion of the yield curve and signaling recession. Does that one indicator alone, is that the key for a recession on the horizon?
No, not in my mind. I mean, I think people discounted at their own peril, but things are a little bit different, maybe not completely. But remember, the term premium is much lower. We've had 17 trillion in global quantitative easing, dragging yields lower. So clearly to me, and kind of lower rates are being imported by Fed policy and what the Bank of Japan is doing. So does the longer end of the curve really represent kind of fair value pricing? I'm not sure it does. So I'm worried about the inversion of the yield curve, but I'm not ready to say it's this perfect indicator that we've seen in the past. I think I'll be more worried if the yield curve continues to stay inverted from about 3 months. We'll see how aggressive the Fed is in bringing the front end of the yield curve down and what, if any, effect that has on the long end.
All right, now, even though the recession's not your base case for your fundamental analysis here, how bad could a recession be at the end of the day?
Well, we hope it's not too bad. I mean, the big fear is that central banks around the world don't have nearly the ammunition to fight it that they've had in previous recessions. But our base case is that even if we get one, and again, that's not what we're predicting, but if we do get a recession, the view is there isn't a lot of excess built up in the real economy. We don't see massive over-manufacturing of, say, housing, residential real estate, commercial real estate, the automotive sectors. Some of the biggest sectors in the U.S. seem like they're sort of working along in kind of a just-in-time inventory kind of fashion. There are lots of excesses built up in the financial markets, again, with negative yields in a lot of places in the world. But in the real economy, are there any massive excesses that need to be worked off? Probably not. There's a good chance that the next recession is kind of a shorter, more shallow inventory correction. That's kind of the way we're thinking about it. If we get one, central banks will have less ammunition, but in theory, they might need less ammunition to fight a simple inventory correction. So we're trying to stay a little bit optimistic, even if we get a recession. And again, that's not our base case just yet.
All right, now what's your outlook on the U.S.-China trade deal? I feel like we have not moved anywhere over the past year. We're sort of where we were when this whole thing ignited last summer.
Yeah, and I think it's a good place to frame it. It's sort of been a lot of sound and fury, signifying not a whole lot at this point. It's kind of the immovable object against the all-powerful force. The reality is, I think what the U.S. wants China to do just can't be accomplished by the Chinese. They are not going to allow us to basically rewrite their internal rules for their industrial policy. We're seeing some sort of positive gestures, some talk at the margin that the Chinese, may end up buying more agricultural products. Maybe that will bring us back to the table, bring them back to the table. And I think we'll have some positive gestures, maybe a little bit of movement. But no, I don't see a lot on the horizon that changes the fundamental fact that essentially this is about industrial policy. The Chinese are not looking to turn back Made in China 2025 anytime soon. And that ultimately, to me, is kind of the sticking issue that is holding up these trade negotiations. So we'll see a little positivity here and there. But no, I'm not expecting an enormous amount on the horizon for U.S.-China trade relations.
Yeah, I agree with you. There's no way they're going to backtrack on China 2025. That's not going to happen. To wrap up here, stagflation, however, it's kind of universally agreed upon. That's what's keeping you up at night, though.
That is the thing. I mean, we don't think there's a lot of inflation in there. When we look around and we check with all the other strategists and portfolio managers within the Natixis family, we don't see anybody else talking about a lot of inflation. So the minute nobody's talking about it, I begin to get worried that that's the thing that's not priced in. And so we're not expecting inflation, but we do see growth slowing. And if inflation were to turn out to be higher than we expect, again, getting in kind of stagflationary territory, more inflation, less growth, really, that's what the Fed doesn't have the tools to fight at this point. So what keeps me up at night is the idea that while none of us believe there's a lot of inflation on the horizon, if we're wrong, that really has the potential to pull the carpet out from under the central banks, which really are trying to take rates down to all-time lows again. So not our base case inflation, but it's the thing that I'm worried we might be wrong about.
All right, David, thanks so much. Appreciate the insight.
Thanks for having me.
Okay, thanks. That's David Lafferty. He's the Chief Market Strategist at Natixis Investment Managers.